Hello there. Well, we always say that investing is for the long term, and the reason for that is, of course, because investments can be volatile in the short term. And generally speaking, those asset classes with the highest potential long-term returns are those that have got the highest volatility. In particular here, I'm thinking about equities or shares in companies. And that's illustrated by this chart here, which is from JP Morgan Asset Management. So this chart looks at the FTSE All Share and it shows every calendar year going back to 1986. So there's 38 calendar years during that period and 26 of them were positive. So most of the time we can say that markets go up. And in fact, in total, over this period, the FTSE All Share returned over 2,544%, which is about 9% per annum. So some pretty good returns. And most of the time, as I say, markets were positive. But of course, saying that 26 out of the 38 went up, that means that there's 12 that went down. So there were 12 negative years during this period. It certainly wasn't all plain sailing. But actually, you get volatility even in good years. So there's lots of years on this chart where we saw a positive return over the calendar year as a whole. So the grey bar goes up. But we also saw quite a strong drawdown. And the drawdown is illustrated by the red dots. That basically shows the maximum amount you could have lost if you'd sort of bought at the top and sold at the bottom during that year. And most years you see a pretty big drawdown. It's pretty rare, to be honest, that you see one less than 10%. There are a few, but often you get a 10% correction in markets, whether or not you end up with a decent return over the calendar year or whether you see a fall. So corrections in markets are pretty common. In fact, we almost would describe them as the price you have to pay in order to get those long-term, longer, higher returns that you see from the stock market. And we suspect that one of those corrections, which is maybe a 10% fall in markets, could be a little bit overdue, simply because we haven't had one for a while and markets have been doing pretty well. And we're slightly worried that perhaps they've got a little bit ahead of themselves and therefore, could do with pulling back a bit. And we think it's really, really important, though, that if that happens, that nobody should panic. It's perfectly normal. They happen all the time. And in fact, for a multi-asset portfolio, such as the ones that we look after, corrections are opportunities because they give us an opportunity to rebalance the portfolio. Now, rebalancing, we think, is really, really important. And I'll give you a really, really simple example. Let's say we thought it was inappropriate for a client with a certain level of risk to have 50% in the stock market and 50% in cash. And let's assume we have a really good period in the stock market and the market goes up 20% and you don't get any interest on your cash in this example. Well, your 50% in equities is now 60%, just purely from market movements. Rebalancing would be to take those gains and take it back from 60% down to 50% again. We think that's really, really important to control the risk because, of course, if you did get a fall in the market, let's say you saw a fall by 20%, then your 60% would actually drop by 12%. You would now have 48% in the stock market. If we rebalance, we reduce the potential loss if we get one of those corrections. But even more than that, it means we can take opportunities of market lows. So right now, for example, equities have been doing pretty well. But bonds have been kind of just bumbling along doing okay. But bonds have seen, because they've not gone up in price that much, have seen their yields look pretty attractive. So we think let's have a bit more in bonds at the moment at a higher yield and a bit less in equities after they've done really well. And if we did get a correction, that simply gives us an opportunity to reverse that and take some profits in the bonds hopefully and put it into a stock market at a lower level. So we think it's really, really important to say corrections are normal. They happen all the time. We can't predict the future. We don't know if and when one might be one around the corner, but we do think that after such a strong run in markets, it's more likely that one might happen. But if it happens, it's not something to panic about. It's absolutely an opportunity. And then we think that is the benefit of having lots of different asset classes in a portfolio at any one time. And more than that, we don't just need to rebalance, and in my example that I gave before, go back to a 50-50 portfolio. You can, if markets fall back, we can go overweight equities and have a bit more than that as markets get higher, we will have a bit less equities. And just trying to sensibly bank gains as they go, as we get them, and take advantage of market dips as they happen as well. We think that will help add to long-term returns. So thanks, I hope you found that helpful. See you next time.